Welcome back to this channel. This is Unfiltered Forex, and I am yours truly, Clement, here for the CPI and PPI breakdown. We got the CPI earlier this week on Wednesday, the PPI came in on Thursday. We're going to discuss both reports and what they mean for the US economy and what they mean for the markets going forward. Let's begin. This is the CPI. These are the CPI numbers we got. I decided to use this one as opposed to looking from the BLS website itself because, yeah, there's a summary of expectations here also. The CPI YOY, which is the big number, the headline CPI, came in at 3%, below the estimate of 3.1%, and also way below the previous number of 4%. The CPI month over month, all items included, 0.2%, as opposed to 0.3% estimate, and the previous increase was 0.1%. Core CPI year over year 4.3%, slight miss from the 5% expected, big decline from the 5.3% we got last month. CPI month over month for June 0.2%, as opposed to the 0.3% forecast and 0.4% previous month's reading. So these are the numbers of the CPI. These are the main ones: 4%, 4.8%, 3%, 0.2%. Of course, this is a big decline, and what that means first is that, okay, let's first discuss why this number came in at 3%. Let's go to the CPI chart. This is the core CPI. Here we are, US Consumer Price Index. As you can see here, this is the chart showing the YOY readings we've gotten so far. And looking at this time range, there's something called the base effect. The base effect is when you're comparing something to something else that happened the previous time. When you're comparing these small numbers that we're getting now to the big numbers that we got here, of course, the change is going to be very big. So this number, June CPI, coming in at 3%, compared, it's a YOY change, so it's compared to prices as of June 2022, last year. This is where the CPI peaked at 9.1%, and that big change from 9.1 to 3%. That's what's called the base effect. The prices now and the prices then are almost the same. So you can see, comparing these high prices to the prices we have now, the change isn't going to be very big, especially because the change at this time was so big. Yes. So now, okay, now that this inflation reading has come at 3%, we're not expecting, that doesn't mean that we also think now is when the CPI is going to bottom and maybe the next month reading is going to come out higher than 3. No, it might continue declining since inflation pressures are seen to be cooling, and it's a sustainable downtrend. As you can see here, it's quite sustainable. We don't expect any increases going forward. Let's look at this one. Yep, here's the inflation breakdown for June 2023 in one chart. This is by CNBC. Motor vehicle, frozen vegetables, motor vehicle insurance, candy, chewing gum, pet food, leased cars and trucks, bread, sugar, carbonated drinks, rent of primary residence. These are the year-over-year changes. These are the prices that have increased the most over the year. And as we come down here to recreational books, used cars and trucks, eggs, televisions, bacon, major appliances, car and truck rental, utility, piped gas service, airline fares, health insurance, gasoline. These are the biggest declines. Of course, in the energy sector is where you would expect the biggest declines, since last year we also had very high oil prices, considering that's when this whole Russia Ukraine thing was starting. So the oil prices and gasoline prices, they were very high at that time of the year. Comparing those prices to the prices now, the declines are very significant. And that's what you can see here. And these are the numbers that contributed to the CPI for all items coming out at 3%, and all items less food and energy 4.8%. Yeah. Okay, so let's discuss how this release is going to affect the markets, right? So first, let's look at it. How much longer will the Fed raise interest rates? Despite the significant easing of core inflation, 4.8%, most economists reckon it won't be enough for the Federal Reserve, which watches that key price measure more closely. As a result, forecasters expect the Fed to raise interest rates again this month after pausing in June to assess the economic impact of its aggressive hiking campaign since early 2022. But the pullback in core price increases could prompt the Fed to hold rates steady for the rest of the year. If you remember, the core CPI, YOI, yeah, it is declining, but not as fast as the headline CPI. We're at 4.8%, and the peak was at 6%, 6.6%. So it's not, we're still further away from the target of 2% than we are, and we're still very close to the 6% reading. So that may not be enough to tell the Fed it's time to pause with these rate hikes things. So that's it. Looking at the CME Fed watch tool, the probability of a rate hike in the next meeting, the July meeting, is still very high at 93%. The probability of a rate pause still very low at 7%. And when we look at the table of probabilities, we can see here the probability of these two hikes, other than the one we're expecting, is quite low for now. You can see here this one picked back up. And in general, what we're expecting now is when the CPI came out, it didn't change much about the probabilities of the next meeting. As you saw in the previous video where I was talking about the weekly forecast, I did mention that the link should be popping up somewhere. I did mention that the CPI would heavily affect these probabilities. Let's look at that. These were the probabilities of rate hikes on Monday. This was on Monday before we got the CPI. The CPI came in on Wednesday. These were the probabilities of rate hikes. You can see these last two rate hikes are the ones I'm monitoring. 5%, 4.2, 3%, 1.8, 0.2%, 0.1%, 21, 33, 29. These are double digits, in fact. So the probabilities of the next two rate hikes, other than the one we're expecting, was very high. And after the CPI came out, these were the probabilities now. You can see 2%, 1.6, 0.9%, 3%. The probabilities of these last two rate hikes dropped significantly. That's because the Federal Reserve, the market thinks the Federal Reserve might not have to hike as many times as they previously expected, because the core CPI number came in very encouraging. You can see here this is 12, 23, 20, 11, 4.8%, and this is where we pretty much close at. So this is for the next 5 meetings, which is in the next one, other than the July one, is in September, November, December, and January 2024. So for these next meetings, the market at that time, after the CPI had been released, was expecting there's a little probability of the rate hikes coming in, more rate hikes, especially these final two ones which the market was expecting. As you can see here, the probability is shifted only slightly for this part, but these other ones, probabilities increased significantly because the market thinks after this hike, the Fed now will have to pause rates. There's a very little chance that they would hike rates again. Back to here, let's go to the PPIs. Yes, core PPI month over month, June, 0.1%, below the expectation of 0.2%, and below the previous one. This is revised from 0.2%. As you can see, they revised from 0.2%. There was a revision showing the core PPI is cooling is cooling fast. This is the PPI itself, all items included, month over month change 0.1% versus the forecast of 0.2% and the revised, so a revision from 0.3%. See, the numbers revised lower, meaning the PPI is also cooling very fast. This PPI is producer price index. This is wholesale prices. The producer price index PPI measures the change in price of goods sold by manufacturers. It is a leading indicator of consumer price inflation, which accounts for the majority of overall inflation. Yes, the PPI is producer prices, producer price index. You can see the chart here of the PPI seems to be quite shaky, wobbly, and with very many revisions, but you can see it's stabilizing almost close to zero, and maybe it might turn negative soon again, but for now these are the numbers. You can see we came from a very high place here, 1.6%, and this is a month over month change. The numbers are very high here, but currently we're seeing these small increases, minor declines, small increases. It's not quite a stable trend here, but we will see. This generally means you can expect the CPI to also continue cooling because prices from the producers are also reducing. As of now, these two, the CPI and the PPI, are the main price indices we were supposed to get for this month, or okay, for this week. The other price measures, like we got the ISM already. I talked about that in the previous videos quite multiple times. The next one we are expecting is the PCE during the last week of this month. That's when the PCE comes out. That's the preferred measure of inflation for the Fed, and we're going to see how that's going to affect the markets during that time. Yeah, as you can see here, yeah, this is on Friday, July 28th, the end of the month. That's when we get the PCE, core PCE numbers, a personal income and outlays report released by the Bureau of Economic Analysis. That's where the Fed's preferred measure of inflation usually is, and we're going to wait for that and see. For now, let's go to the charts. Here we are. This is the US 30, the US 30 Dow Jones Industrial Average. Let's look at the reaction here. This was on Wednesday, right? On Wednesday, this vertical line marks Monday when the week started, and continuing on Tuesday, you can see the price of the US 30 was picking up quite high here. Pause there, then come Wednesday, another rally, which most of it was cleared out when the New York Stock Exchange opened, but it still managed to stay above the highs, close the day green. As you can see here, price quite stabilized in the following day and again jumped on Friday when the bank earnings came out. It came out good numbers. Let's go to the dollar index. This is the dollar index. As you can see here, quite strong downtrend, which started on Friday, the Friday of the NFPs. Yes, Friday 7th July. That's when there was a very big impulse here. And then in the following week, Monday, Tuesday, Wednesday again, another steep decline of 1%, breaking below the support here. You see, this was quite a major support, but price managed to fully break out past it. Now that the CPI came in cool, and the market is expecting the Federal Reserve won't have to raise rates as much as previously expected. Sell-off continued the following Thursday after the PPIs came out and supported the narrative that inflation is cooling, and then on Friday kind of consolidated. This is what I am expecting it to do. A slight retracement, then we can continue the downtrend. But I may be wrong, I may be right. We'll just have to wait and see. But for now, this is what I'm expecting. Since before the next Fed meeting, before the next FOMC meeting, before the next PCE reading, before the next CPI reading, before the next NFP reading, maybe the DXY will continue to fall until then. So for now, that was it for this video. I didn't want to look at many pairs. Just wanted to take a look at the stock market and look at all currencies as a whole by just looking at the dollar index, and that was it. More explanation maybe about how the week has been on the weekly recap. Stay tuned for that.